Okay. Hopefully I'm audible to those of you that are still awake in the audience. I'm going to give a quick historical tour of what happened to create the markets that we trade with today, okay? So we're going to look at equities markets, we're going to look at foreign exchange markets, and then we're going to look at crypto markets. And I'm going to be asking a few questions. And the first question is, has technology made capital markets more efficient today or not? Is transparency beneficial to markets? Obviously, transparency is a good thing. If someone's transparent and honest and open, it's a good thing in human interaction. But is that necessarily a good thing in capital markets? We've got these big global exchanges all around the world, in CME, Binance. Given that there are these huge exchanges, why do we still have a lot of importance placed on OTC liquidity? And then I'm going to speak to you roughly about hedging. Some of you will understand that, some of you may not have heard that before, but why is hedging relevant to pricing? Okay. Digitization has had a massive impact on technology. If you go back only 50 years, you had a world that was fully paper-based. Market makers, and their role was to price instruments literally using their fingers. That evolved over time to the middle section, which is the banks, the big banks, Goldman Sachs, JP Morgan. They became the big liquidity providers. And those were the guys that were making prices and managing risk. And today, at my company, at XNES, we're the largest in the world. We trade $4 trillion per month, and we don't have a single person in our company with the title trader. 100% of our business is executed through machines. So that's what digitization has done for markets. But I want to quickly talk you through some common concepts so you understand, when I mention the word transparency and pricing, you understand as a trader what that really means. So let me just explain. This is what's called the order book, okay? And the order book, it shows transparently all the prices and the volumes. In this case, I'm looking at Bitcoin, but this applies in foreign exchange, this applies in equities as well. You have offers. These offers is the price that you can buy from the market. You have bids. These are the prices that you can sell to the market. So these are terms that are very well known today by traders in transparent markets. You have the volumes. That's how much of an asset you can purchase. So in this instance here, I can buy 1.19 Bitcoins for a price of 28,367. So again, that approach is similar in equities and in foreign exchange. You have the notion of a best bid and offer. So what's the best buying and the best selling price in the market, or sometimes referred to as a touch price. And so when you think about markets like this, when you think about the order book, what we're led to believe is that all prices and volumes are visible to everyone, therefore it's fair and transparent. Well, to a degree, that's true, but it doesn't mean those prices are executable, which is different. We're led to believe that prices that you see on these screens in all these trading terminals around the world are a state-of-the-art snapshot of the real-time price. To a degree, that's true, but as I'm going to show you, in reality, it represents the buying and the selling of a very small group of sophisticated organizations around the world. That the best bid and offer is the best price. As you'll see, it doesn't mean it's the best price that you can execute at. That centralized exchanges, these huge exchanges, are where all price formation takes place. Again, that's not true. The OTC liquidity market is far more important. And then finally, that the prices that you see are really the best prices that are there. And I can say that those prices, they represent the prices from a few small players, and these small players, they put, if you like, a buffer around their prices to allow for toxicity or toxic flows. So in other words, I'm basically saying we have big transparent markets across asset classes, but they're problematic if you are a specialist and a practitioner. So what you see here on the screen is the reality of everyday markets. So when you are sat at home, you're using a trading terminal, and you're interacting with the order book to buy or sell. In all probability, across asset classes, you're interacting with one of these kind of firms: Citadel, XTX, Jump Trading, Hudson River. They're all big global market makers. They have billions of dollars, and their job is to facilitate buying and selling. So me, Damien Bunce, buying something in the market, in all probability, I am buying or selling that from a market maker, a digital electronic market maker that dominates pricing using computers and machinery. So let me just explain, and I'm going to apply this logic now to equities, to foreign exchange, and to crypto, to give you all an understanding of how our markets got this way in the last 10 years. So there was a time, again, equities, buying and selling shares, when in the early 2000s, if you wanted to buy an American stock, you went to the New York Stock Exchange. A London stock, you went to the UK London Stock Exchange. And if you were buying a German stock, you went to the Deutsche Börse. Okay, so these exchanges, they dominated the landscape, regional power players. And of course, they charged very high prices. And they had a very strong, sticky position. And over time, the banks and other organizations got fed up with this dominance. And so what happened was the disruptors occurred. So this is about 2005. And I'm looking here just at the UK market to simplify it, but this happened all over the world. The disruptors came along. And in the UK, this was Turquoise, Chi-X, and BATS. Turquoise was 12 banks getting together saying, we've had enough of the dominance of the London Stock Exchange. We're going to create our own exchange. BATS was an American-based exchange, actually in Kansas, that decided to enter the UK market. And Chi-X, a private equity-backed firm. So what problem did this create? Well, suddenly, BT Group, a big UK company, was now trading on 4 exchanges. So if you wanted to purchase BT shares in the market, either as an individual or as a bank, you had to now go to 4 locations. So you can imagine the complexity of trying to do something like that in near real time. So Goldman Sachs and every bank at the time, I refer to Goldman as a former employer so I understand it, but they created this thing called a smart order router. And it's a very sophisticated piece of technology that exists today in global equity markets. And what a smart order router does is it intelligently goes out to those 4 exchanges and it purchases stock. But that's not enough, because what then happened was dark pools emerged. So these are off-exchange order books. Okay, it's liquidity that doesn't exist on the exchange, that exists inside the banks. So this notion of dark pools that some of you will have read about also evolved. So you had equity markets with liquidity on exchange, on disruptors, and now inside banks. And someone somewhere had to bring all that liquidity together to execute a trade. So let me give you a real example of how this works. I want to buy 10,000 shares of BT Group stock, which would be a price of 1,172,500. You can see that the best price in the market, the ask price in this case, is 117.25. So this is what happens today. Goldman Sachs, or a big broker, goes to the London Stock Exchange to buy 10,000 shares. It can purchase 200 at this price. It can purchase another 1,000 at this price. And then the remaining quantity at 117.28 to give it a total order value of 1.172 million. Okay? That's the first option that the bank has. The second option that the bank has is to go to one of these alternative venues, Chi-X, and then to buy 10 shares, and then 9,900 shares, and you get another average price for that execution. And then the third option, and you can see how the complexity is growing and growing, and I've desperately simplified it here. The third option to buy shares, which is what happens today, is that Goldman Sachs first of all says, do I have anything myself? And it says, you know what, in my own pool, I've got 9,600, so I'm going to take that first. Then it goes to the London Stock Exchange and takes the best price. And then it goes to Turquoise and takes the best price, giving it an overall execution price of 1,172,500. So when you look at this and you think about best execution, so in the first scenario, I bought shares from one venue. In the second scenario, I bought shares from another venue with a better price. And in the third scenario, I bought my shares across all of these complex venues, the digital side of it, the complex side of it. And it turns out that the best execution is achieved in scenario 3. So when you think about liquidity, transparency, and you think about the public exchanges, just bear in mind that behind the scenes, actually, this is what's really happening today. So now let's look at the foreign exchange markets. The foreign exchange markets are also totally decentralized. So liquidity for foreign exchange exists in all parts of the world. And in fact, the big dominant exchanges, like the CME, the CBOE, and ICE, Intercontinental Exchange, they've purchased the liquidity over the last few years. But this is what the market looks like today. Liquidity is all over the place. And so in the foreign exchange markets, you do not have a concept of a smart order router, which I showed you earlier. It doesn't exist in foreign exchange. But you have the notion of aggregators. So these are pieces of software, and their job is to figure, of all of that big, complex, massive liquidity, who's got the best price? Because I want to execute at the best price. All of us want to execute at the best price. And so in this example here, I want to buy 20 million euro dollar. You can see that LPX, liquidity provider X, has in fact got the best price and the tightest spread. So it's logical that I would want to execute with this particular liquidity provider. So that liquidity provider, again, this is transparent. These markets are visible. You would think that that would be a good thing. So I decide to give my 20 million euro dollar order to this liquidity provider because they've got the best price. But what I don't know is that liquidity provider doesn't actually want the order flow. They don't want that position. They just want to earn the spread. So I've paid them the spread, and what they immediately do is they automatically unwind that order. They hedge that order in the market. Maybe they hedge it at 1 million a time. So 19, 18, 17. And every time they're hedging that order back into the market, they're having a 0.2 pip impact on my original order. So what I've done is I've gone to a liquidity provider that has the best price, because an aggregator's told me that. I've paid them the spread, so they're happy, but then they've unwound that trade, and it's caused 0.2 pips market impact on my order. So for the 2 pips benefit I gained, I lost 2 pips on 19 million, which is clearly a bad execution. So it's another example in foreign exchange where transparency and pricing are just not aligned. And now let's look briefly at crypto markets. So the crypto markets, again, are highly decentralized. Binance today is by far the most dominant exchange in terms of spot crypto liquidity, as well as perpetual futures, what we refer to in my company as contract for difference. But Binance is by far the biggest. But the centralized exchanges that exist today are inefficient. And let me give you some examples. This is my Bloomberg when BlackRock, which is the largest asset manager in the world, announced plans to launch a spot Bitcoin ETF. That news moved Bitcoin by 10%. So one piece of news from a prominent company moved Bitcoin by 10%. Imagine if you're purchasing Bitcoin at that period of time. It's a bad time to buy, particularly as it comes back. Similarly, we also know, and this is another one of the exchanges, if you're executing 200 Bitcoins, that's quite a big order, I understand that, but 200 Bitcoins can move the market 10%. This is a real transaction that took place. And in this scenario here, you can see that every time 200 Bitcoin purchase is made, the market immediately moves by 10%. Now we have to think about one of the industry problems. So BlackRock has announced it's now going to launch its spot Bitcoin ETF. But how is it going to achieve that? If you were to take BlackRock's assets under management, which are 10 trillion, and let's just assume that you just want to cover 0.01% of those assets with this ETF, they would need to go into the market and purchase 188,462 Bitcoins, which is, as you can imagine, extremely challenging, bearing in mind the kind of market impact that a 200 Bitcoin purchase has on the markets today. Crypto's just not ready for it. It's not got the same institutional grade infrastructure that you saw in equities and in FX. So I'm finishing up now with just a summary. The summary is, I asked the question, has technology made capital markets more efficient today? Well, in reality, if you didn't have this high-tech aggregators and smart order routers, we just wouldn't have an ability to piece all this liquidity together. So in that sense, obviously technology's played a very important role in piecing this liquidity together and making these new markets. However, at the same time, the strongest players in the technology space have been able to dominate markets. So it's a smaller group of people making more money. Is transparency beneficial to markets? Of course, transparency is obvious, but you could see in equity markets that if I'm purchasing stock, it may well be that a lot of that stock is actually off exchange in dark pools or something like that. And similarly, in FX markets, we have a slightly different problem, but we don't know that best price is necessarily equivalent of best execution. If we have all these big exchanges, why is the OTC market so important? And it's simply because of market impact. If you try to execute fairly decent large size orders in transparent markets, it's like throwing a stone into a pond. There's a ripple effect, and the ripple effect can be negative on your execution. That's why OTC private markets are increasingly important. And then finally, why is hedging relevant to pricing? And you saw earlier on in FX markets, if you're executing with a counterpart that has the best price, doesn't necessarily mean that you get best execution, particularly if that counterpart just simply hedges your trades away. So thank you for those that have listened. I hope I gave you a quick historical tour around the formation of markets in equities, FX, and of course, an insight into what may happen in the future with crypto, because clearly that presents plenty of opportunities. Thank you all.